Hi, everybody. Good morning, good afternoon, good evening, wherever you are around the world. Welcome to Family and Finance. My name is Rose Joshua. Professionally, I'm an insurance agent and a real estate agent. On the Family and Finance channel, we provide you with lots of valuable information that can help you make your life decisions. Today, I'm going to continue with what not to do when you're buying a house. In my last two videos, I talked about not going on a spending spree and basically not changing jobs that would impact your income. Today, I'm going to talk about a very, 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 very common mistake that home buyers make when they're buying a house. And that has to do with things that are basically automatically done because we don't ask the necessary questions. So we fall into this common mistake. And today we're going to be talking about the MPP, which is a mortgage protection plan. And my slogan today is no to MPP. If you have an MPP, call your finance 911. That's me, and I will help you to fix it. So today we're going to do a deep dive and really tackle this question in a way that will help you to understand the real situation with mortgage protection plans, okay? I'm going to share my screen. Today I'm going to be teaching, so I'll share my screen. So, mortgage protection plan is your lender's mortgage insurance. So when you get a mortgage, there's a lot of papers that say sign here, sign here, sign here, sign here. And a lot of people are not asking questions about what they're signing. And one of the most common sign here is, oh, just so we protect your mortgage. If anything happens to you, then the bank will not go after your family, which makes sense, but it's way, 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 way deeper than that. So mortgage protection plan is a no, no, no. There are some exceptions. Actually, there's one major exception, and we're going to talk about it at the end of this session. But otherwise, it's a no, no, no. Do not take your lender's mortgage insurance. You should come to me and buy your own personal insurance. So no to MPP and get your personal insurance. Let's talk about it. Okay. So many questions to ask today. The first question is that of ownership. In an MPP scenario, which is your lender's mortgage insurance, it is a group policy. It's a group insurance. And so it's grouped. So all the policy holders are grouped, and the policy holders are not the policy owner. So the policy owner is the bank, which is the lender that has a master contract relationship with the insurance company. So let me give you an example. So you have a big employer, say company ABC, and then they go engage an insurance company, say company XYZ, and they say to the insurance company, okay, we want you to cover all our borrowers. Okay, and they enter into a relationship with that company, that insurer, so that everyone who borrows from them, who gets a creditor insurance, is insured by that company. So there's a lot of people who I know, for example, may have, common examples are like Manulife, Capital, no, not Capital One, I think. There's quite a few names that are out there that are big creditor insurance companies, all right? Canada Life, for example. So it's very similar to your group insurance at work. So your employer would enter into a relationship with an insurer. And so all the employees of that company have a policy with the selected insurer. Now, you're just a policy holder, but not the owner of the master contract. So what that means is that the lender is the one who controls everything. And he tells the insurance company what to do, and they reserve the right to make changes whenever they want. It's really out of your control as the insured person. All right. So the lender is protecting themselves. The reason they went to engage the insurance company is to protect themselves because you owe them money. So they want to be sure that if anything happens to you, they can collect their money. It's not really for you, it's for them. You need to understand that fundamental, that foundation of grouped MPP, which is your mortgage protection plan. All right. On the other hand, when you have your own policy, when you have your own personal policy, you approach an insurance company, or you work with an agent to connect you directly to an insurance company. And so your relationship with that company is direct. There is no middleman, which is the bank. There's no middle owner. You are the owner of your own personal policy, and you negotiate the terms of that policy. And the policy is customized to you. One thing I forgot to mention, then I will go into more details a bit down the road, is that everything around the grouped MPP, including the premium, is grouped as well. So some healthy people pay more because the grouped MPP has to allow for the not so healthy people. So it is an average kind of formula that they use to take care of everybody. But when you have your own personal policy, it is your own policy customized to you, your age, your gender, your health. Okay. So putting it all together, you can see that in the MPP picture, the bank is the stronghold in the middle there that owns the contract, and you're just in a group, really. And your relationship with the insurance company is that of the bank's clients, the bank's borrowers, not really that the insurance company has no strong relationship with you. They're just servicing their relationship with the bank, with your lender, okay? Whereas in the personal picture, you are directly related. The insurance company cares about you as their own customer, and you have more control, you have more flexibility, more negotiating power. All right. So a lot of people care, I wouldn't say carelessly, I think it's just lack of, not not having the knowledge. A lot of people kind of find themselves in an MPP, again, because we're not asking questions. We just believe that, the mortgage protection plan is to protect me from my mortgage. If anything happens, they pay off my mortgage. Yes. But it's not as simple as that. Okay, so we've already looked at question number one: who owns the contract, which is the lender owns the contract. Okay, and they are protecting themselves, so it's for their own purpose. And you, for yourself, have a personal relationship with your insurer, and you're able to negotiate better. One of the biggest differences between an MPP and which is your lender's insurance policy and your personal insurance policy, is that the lender is the beneficiary, meaning that if you pass away during your mortgage, meaning you have not paid off your mortgage, the insurance company will pay the lender the money. they will pay the balance of your mortgage directly to the lender. They don't know your family. The insurance company does not care who your family member is. Their allegiance is to, their job is to pay the lender the balance of your mortgage. So technically, when a homeowner passes away, the lender or your bank makes a claim. They send a claim because they're the beneficiary. They do a claim to the insurer, and the insurer confirms that the owner has passed away, and so they pay the lender as the beneficiary. All right, so literally the lender is protecting themselves. You gotta remember that in a mortgage protection plan, lender's insurance, you are not the one being protected, is the lender protecting themselves. Now, on the other hand, in a personal insurance policy, you choose who your beneficiaries are. And if the homeowner, sometimes I don't like to say you, but if the homeowner passes away, then the beneficiaries receive the payout, not the bank. Now, the beneficiaries, of course, are going to pay the balance of the mortgage, but they also have a right to decide how to spend the money, either other pressing needs. All right. So there's a lot more flexibility there. Now, the third question we want to ask is, how much exactly is paid out in these policies? Now, in a lender's mortgage protection plan, which is your lender's mortgage insurance, they have what is called a decreasing benefit. That means that, let's say you buy a property for $400,000, or you have a mortgage initially for $400K, and then you amortize that over 25 years, and you maybe down the road, the homeowners paid it for like 12 years and is now down to $150K. So balance remaining is $150K. If the homeowner passes away with $150K balance on the mortgage, the lender receives $150K from the insurance company. All right? $150K. So the question is, what happens to the remaining $250K? All right? The family does not get that. The insurance company keeps the rest of it. Okay? Remember also that at the beginning of the transaction, you're paying for coverage on $400K. But even though the benefit amount is decreasing every year with your payments, your premium does not go down. Your premium stays the same, all right? And could increase, and we're going to talk about some circumstances under which it goes up, all right? So it is decreasing benefit level or increasing premium, and you don't get to keep the change, or your family doesn't get to keep the change. So it's really a loss situation for the family, because you're losing a lot of money, all right? So on the personal side, if you have your own policy, it is a level benefit amount. So in that $400K example, regardless of when the homeowner passes away, is $400K. Regardless of the amount of mortgage remaining, is $400K that's going to be paid out to the beneficiaries. The family always gets, or the beneficiaries always get, the full amount. It's not decreasing. Okay. Question number 4. Who gets to keep the change? We already touched it in question number 3, that let's say you had a $400K mortgage, now it's down to $150K. If you have a lender's MPP, mortgage insurance, from your bank, from your lender, okay, they will pay the $150, but you don't get to keep the change. The insurance company keeps the change. The insurance company holds the rest of it. But in a personal insurance, your family keeps the house. In both cases, your family keeps the house. But in the lender's MPP, insurer keeps the change, your family keeps the change. So your family will pay out the balance of $150K on the mortgage, and they will keep the remaining $250K for other things, other needs. So if you have a lender's MPP, you would have lost the $250K, or your family would have lost that. So it's not as simple as it looks on the surface. Okay? I hope this is making sense to a lot of people. All right. Next question. What is the relative cost of whether you have a mortgage MPP or your personal insurance? As I mentioned in the very beginning, in a mortgage protection plan, you are in a group. So similar to your group benefits at work, they structure the premiums in such a way that they accommodate the oldest people and those who are unhealthy, the sickest people. All right, because insurance is about risk. So even though you may be healthy, because they're averaging you with all the oldies and all the unhealthies, you get to pay more. You're not paying for your own health situation. You're paying your own plus more because they're averaging you with higher risk people. So it's more expensive for healthy people. All right. And so you can tell the story on the other side that if you have a personal insurance policy, you get to pay lower, especially if you are younger, because the younger ones pay less and the healthier ones pay less. So if you're young and healthy, you get low prices. All right. But in a group, in an MPP, that's not the case. You pay more. All right. I hope you're making notes. Question number 6. Lots of questions. Lots of questions that we must ask. Number 6, is the coverage tied? And the answer is a big yes. If you have your lender's MPP, which is the mortgage protection plan, mortgage insurance from your lender, it is tied to the mortgage. It is tied to the mortgage and mortgage only. You cannot use the money. Actually, you don't have access to the money, but the money is only for paying for the mortgage. Nothing more. Nothing more. So this has other impacts we're going to talk about in a few more minutes, but only the mortgage is where the money goes. In a personal insurance policy, is not tied to anything. So you have the flexibility to spend it as needed. There's other things like children's education, other projects, you have other bills like student loans, whatever it is the family needs is what they're going to use the money to take care of. All right, so very, very close to the tie-in, very, very close to the fact that the mortgage protection plan is tied to your mortgage is the next question, which is what if you refinance? In many cases down the road, people go, oh, I don't like my lender. I'd like to change companies. Okay. Or, oh, I have other bills I'd like to consolidate with my mortgage. Okay. When you do that and change lenders, guess what? Your MPP is done. Because MPPs do not travel from one lender to another. They are not transferable. They are not portable. They don't travel. They stay with your one lender. So if you do change lenders midway, you have to get a brand new MPP. Guess what? At a higher cost. Why? Because you're older. All right. So the fact that insurance is tied to the mortgage is a really, really detrimental factor. All right. But what happens on the other side? Even if you refinance, even if you change lenders, even if you, whatever you want to do with regards to the mortgage, there is no impact on your personal policy. Why? Because the personal policy is not tied to the mortgage. So whatever is happening on the mortgage side does not affect it. Here is a big one, number 8. Question number 8. What if you sell the house? Big question. You don't even have to sell the house after amortization. Somebody can decide to sell the house after 5 years, after 10 years, doesn't matter, okay? But here's the thing. If you only have mortgage protection plan as your life insurance approach or strategy, you have a big problem, because when you sell the house, the MPP ends, meaning that the lender's been paid off. There is no more risk. They don't need to protect themselves any longer. They're done with you. They are done with you. And so the MPP, the mortgage protection plan, ends, and guess what? You are maximally exposed. And unfortunately, you are older. And so what happens? To now go get a personal policy, more expensive. A lot of people I've seen find themselves in this trap. It's a big one. If you do sell the house, no more coverage. No more coverage, nothing. All right? But if you sold the house, but you have personal policy, there is no impact. Your personal policy, your personal insurance is protected no matter what is happening on your mortgage side. It's not tied again. All right. The next question, and I think I have the number 8 twice. Question number 8 again, but it's number 9, actually. Correction there. What happens when you renew your mortgage? Okay. When you renew your mortgage, in most cases, the premium is recalculated at your higher age, and the premium goes up. Okay. But on your personal side, there is no impact, because again, it is not tied. That untying for a personal policy is a big deal. Big deal. You gotta get your personal policy. Here is another common one. Have you ever heard a case where somebody had a mortgage, they had a mortgage protection plan, and then they passed away, and then the company declined or refused to pay out the insurance? Why? It's something called post-claim underwriting. Post-claim underwriting means that the lender, the insurance company, conducts their underwriting, medical underwriting, after the homeowner has died. Guys, this person is dead, and they're declining the payout. How can that happen? When somebody passes away and is a mortgage protection plan, it is when the person passes away that they now call for doctor's reports, attending physician statements. Can you tell us what happened to this person when he applied 10 years ago? Can you tell us what was happening with this person when he applied 20 years ago? And if they find that there was missing key, what they call material evidence missing, they could deny the claim. So somebody could just pay, and this post-claim underwriting just wipes it all out. Very, very, very big deal, guys. So please, if you have an MPP, you know what I'm thinking. And I know that you know what I'm thinking. All right. So if you have a personal insurance policy, they would do underwriting upfront at the time you apply. Okay. And they would approve you upfront. There's a commitment upfront. Okay, there's two cases where you have to watch. That's what they call the 2 years of incontestability and 2 years of no suicide. As long as you didn't kill yourself within 2 years of getting a personal policy, you're okay. And as long as after 2 years they're not able to contest the policy, you're okay. But upfront underwriting, upfront commitment. All right, so MPP, no. If you have an MPP, we are talking. You and I need to talk. All right. Last question. I believe we talked about it at the beginning. Where is the insurer's allegiance? The insurer's allegiance is to the lender. The lender is the one who's paying their fees. The lender is the one who is feeding them bread. So they report an answer to the lender, not to you. Okay, the lender may decide to cancel the MPP anytime. Or the lender might say, okay, I don't like you, this company A, I don't like you anymore. I'm going to move my coverage to another company. So this insurance company is ready to dance to the tunes of the lender. They're not dancing to your tunes. They don't care about you. All they care about is the lender, right? That's who feeds them. That's who's paying their fees. But if you have a direct relationship with an insurance company, you have your own personal insurance, the power is in your hands. So they pay more attention because now you're the one feeding them. Okay, insurance pay allegiance to where the money is coming from. All right, so very, very important. So this is a summary of all of it. Question number 1, who owns the contract? In an MPP, the lender, not you. Who is the beneficiary? MPP, the lender, not you. How much is the payout? Decreasing benefit for you is level. Who keeps the house? In both cases, the family keeps the house, but who keeps the excess money? The insurer keeps the excess in the lender situation. Your family keeps the excess in a personal policy. Relative cost, you're paying more in an MPP because it's creditor, group creditor plan. It's a group creditor policy. All right, so you're paying more. And what are the ties? Big deal, tied to the mortgage in a mortgage protection plan from your lender. All right, what happens if you change lenders? What happens if you sell the house? What happens to renewal of mortgage? You have to readjust, and it's a big deal. Okay, especially if you have no more coverage because you change lenders or because you sold the house. All of these have no impact on a personal situation. And of course, the big volcanic eruption of post-claim underwriting where you are not guaranteed to get the money. Your family is not guaranteed. Basically, there is no guarantee to pay out in an MPP because of that post-claim underwriting if they find some missing or incorrect material evidence. All right, well, skeletons in your cupboard. So there is one exception under which I can say, yes, if you have no choice, then I will give you permission to get an MPP, to get a lender's mortgage insurance. And that is if you are not healthy, you know that you have searched around and everybody's declining you, okay? You're high risk, you can't get your own insurance, all right? You have no choice. Under that situation, yes, you're stuck with the lender. You're stuck with the lender's insurance. So yeah, go and get that one. But otherwise, if you're healthy, if you're young, and you can get your own policy at a lower price, get out of the insurance of your lender's mortgage insurance, which is MPP, Mortgage Protection Plan. There's all kinds of words confusing people. So is mortgage insurance, it covers me, like it is a form of insurance, but it's not the right form for your mortgage. Okay, so if you're young, if you're healthy, and you can get your own personal insurance, talk to me. Okay, do not keep the MPP, do not take it if you have not taken any. So for next steps, if you are under the sound of my voice and you live anywhere in Canada or United States of America and you own a home and you have a lender's MPP, call me. Let's sit together and let's help you. Okay, it's a big trap. And, you know, we've been talking about it now for how many minutes? It's a big trap. Stop throwing away your family's money, especially in a case where there's change at the end that could help your family. Why would you give that all away? Okay, so stop throwing things away. Come, let's sit together. Come, let's get you a personal policy. So forward this video to all your friends and family, and let's help one another. If this has been helpful, for sure, subscribe and share with your friends. Call me, 780-680-1334. All right, and let's help one another. Thank you so very much, and God bless you.